The UK property market is experiencing something we haven't seen in over a decade. And what's happening right now could completely reshape who owns property in this country. While house prices in London are barely moving and some areas are actually falling, properties up north are flying off the shelves with double-digit growth. But here's what nobody's really talking about. There's a mortgage time bomb ticking away that's about to hit 800,000 homeowners, and most of them have no idea what's coming. If you own property, if you're renting, or if you've been sitting on the fence waiting to buy, what I'm about to share could save you tens of thousands of pounds or help you spot an opportunity that most people are completely missing. Before we dive in, make sure to hit that like button and subscribe to Property Reporter, because we're bringing you the latest property news and analysis you won't find anywhere else. Right, let's get into it. The UK property market has literally split in two, and the gap is getting wider every single month. Up in the northeast, property prices have surged by nearly 8% in just 1 year. Manchester, Liverpool, Newcastle, these places are seeing bidding wars and properties going under offer within days. Meanwhile, down in London and the southeast, asking prices have been creeping down month after month, and sellers are having to slash their expectations just to get viewings. We're talking about a market where a 3-bedroom house in Newcastle might cost you £180,000, while the same house in outer London is pushing £450,000 or more. The affordability gap has become so extreme that people are genuinely asking themselves whether it's worth staying in the south at all. What's driving this isn't just about preference or lifestyle. It's cold, hard mathematics. The average salary in London might be higher, but not high enough to justify mortgage payments that are double or triple what you'd pay up north. When you factor in commuting costs, council tax, and general living expenses, you're looking at a situation where someone in Manchester with a £200,000 mortgage is living a significantly better quality of life than someone in London with a £400,000 mortgage and a longer commute. And buyers are waking up to this reality fast. The data shows that supply in London is up nearly 19% compared to last year, which means sellers are flooding the market. But transactions, the actual sales going through, those are down 28% year on year. People are listing, but nobody's buying at the prices sellers want. That's creating a standoff. And in a standoff, prices only go one direction. Here's where it gets really serious. Between now and 2027, around 800,000 homeowners are going to see their fixed-rate mortgage deals expire. These are people who locked in rates at 2%, maybe 3% back when money was practically free. Now they're coming off those deals and facing rates of 5% or higher. Let me put that in real terms for you. If you borrowed £250,000 at 2%, your monthly payment would be around £1,120. When that deal expires and you remortgage at 5%, that same mortgage jumps to about £1,460 a month. That's an extra £340 every single month, over £4,000 a year. For families already stretched thin with energy bills, food costs, and everything else going up, that's not just uncomfortable, it's unaffordable. And if you think that sounds bad, consider this. If you don't remortgage and you fall onto your lender's standard variable rate, you could be looking at 7% or even 8%. At 7%, that £250,000 mortgage costs you £1,750 a month. You're now paying an extra £630 compared to your old deal. That's over £7,500 a year just in additional interest. For tens of thousands of homeowners, particularly those who bought at the peak of the market in 2021 or 2022, this isn't sustainable. They stretched to afford the property at low rates, and now they're facing a choice. Find an extra few £100 a month somehow, or sell up before they're forced into a worse situation. This is why we're seeing supply increase so dramatically. It's not that people want to sell, it's that they have no other option. The really brutal part about all this is the generational divide. If you're over 65, there's a 61% chance you own your home outright with no mortgage at all. You're sitting pretty, watching your property value tick up slowly, no monthly payments to worry about. But if you're under 45, you're almost certainly carrying a mortgage, and you're the one feeling every single rate rise. Younger homeowners hold the bulk of the UK's mortgage debt, and they're the ones getting squeezed hardest. This isn't about blaming anyone, it's just the reality of when different generations bought and under what conditions. But it does mean the pain of higher rates is concentrated in a specific group, and that group is now flooding the market with listings because they physically can't afford to stay. Now, let's talk about landlords, because this is where the market is seeing an absolute exodus. Last year, 19% of landlords sold properties. Compare that to just 8% who bought new ones. That's a massive net loss of rental stock, and it's accelerating. Recent surveys show that 41% of landlords are either planning to reduce their portfolios or exit the market entirely within the next few years. Think about what that means. Nearly half of all landlords are considering selling up. Some of them are just tired of the hassle, but most are being pushed out by simple economics. Mortgage rates have more than doubled for them too, but they can't just pass all of that cost on to tenants because there are limits to what renters can actually afford. Then you add in the regulatory changes. The Renters Reform Bill is shaking things up in a big way, and a lot of landlords just don't want to deal with it. The bill scraps Section 21, which means landlords can no longer evict tenants without a specific reason. That might sound great for renters, and in many ways it is, but from a landlord's perspective, it adds risk. If you get a problematic tenant, it's now much harder and more expensive to remove them. Then there's the furnished holiday let changes. The tax benefits that made short-term holiday rentals attractive are being stripped away from April 2025. Landlords who relied on those perks are now looking at their numbers and realising it's just not worth it anymore. So they're selling, often, to owner-occupiers, which means those properties are leaving the rental market forever. What's wild is that this landlord exodus is creating a perfect storm. On one hand, rental supply is shrinking, which is pushing rents up in many areas. On the other hand, all those former rental properties hitting the sales market are adding to the supply glut, which is pushing house prices down in some regions. It's a bizarre situation where renters are paying more while house prices fall, and it's all because of this mass exit of landlords. Former rental properties now make up a significant chunk of the listings you'll see on Rightmove or Zoopla. In some areas, it's 1 in every 5 or 6 properties. These are often well-maintained homes in decent locations, and they're being snapped up by first-time buyers and families who were previously renting. In a weird way, the landlord sell-off is creating opportunities for people who've been locked out of ownership for years. But here's what makes this fascinating. While the overall market is struggling, there are still pockets absolutely thriving. Manchester, Bristol, Glasgow. These cities are seeing serious growth. Property investors who know what they're doing are still finding deals that make sense. Buy-to-let mortgage applications actually surged by 32% in early 2025. Yes, you heard that right. While nearly half of landlords are planning to exit, there's a smaller group of professional investors coming in and buying up properties at decent prices with rental yields of 6% to 7%. These aren't the accidental landlords who inherited a property or kept their old flat when they moved. These are people who understand the numbers, who've planned for rate rises, and who see the current chaos as an opportunity. The North and Midlands are where the smart money is going right now. You can still buy a decent 2-bedroom flat in Liverpool for under £120,000 that'll rent for £800 a month. That's a yield of 8% before costs, and even after expenses, you're looking at a solid return. Compare that to London, where you might pay £400,000 for a flat that rents for £1,800 a month. That's barely 5% gross, and after costs and void periods, you're lucky to see 3% net. The numbers in the south just don't work anymore, unless you bought years ago and have a massive amount of equity. But up north, in the Midlands, parts of Scotland, there are still deals to be done if you're willing to be a professional about it. First-time buyers are also starting to see opportunities. With landlords selling up, there are more properties available, and some sellers are getting desperate enough to accept lower offers. Transaction volumes being down 28% means there are fewer buyers competing for each property. If you've got a decent deposit saved and you can secure a mortgage, you have negotiating power right now in a way you didn't have 2 or 3 years ago. The key is being selective and not overpaying just because you're desperate to get on the ladder. Properties that were listed at £300,000 6 months ago are now being reduced to £285,000 or £280,000. That's real money saved just by being patient and doing your homework. What absolutely nobody is talking about enough is the sheer collapse in transactions in certain periods. There have been months recently where activity dropped by over 60% compared to the same month the previous year. 60%. That's not a slow market, that's a frozen market. People are paralyzed by uncertainty. Buyers don't want to commit because they're worried prices will fall further or that they'll overpay. Sellers don't want to drop their asking prices because they still remember what their neighbour's house sold for in 2021. So everyone's just waiting, and nothing's happening. This creates a strange situation where the market data looks relatively stable on the surface because there aren't enough transactions to move the averages much. But underneath, there's this massive tension building. Then there's the Help to Buy aftermath that we really need to address. Back in 2013, the government launched the Help to Buy equity scheme to help first-time buyers get on the ladder. Sounds great in theory, right? The problem was it only applied to new build properties, so buyers were funneled toward developers who knew they had a captive market. A lot of those developers added a premium to the asking price, sometimes 10% or 15% above what the property was actually worth. The government loan helped with the deposit, sure, but buyers were still overpaying for the property itself. Now, fast forward to 2025, and many of those buyers are finding out their properties haven't appreciated the way they expected. Some are even worth less than what they paid. Imagine buying a new build flat for £250,000 with Help to Buy in 2017 or 2018, and now, when you go to remortgage or sell, you find out it's only worth £230,000. You've been paying a mortgage for 7 years, and you have less equity than when you started. That's the reality for thousands of people. The developer premium they paid has evaporated, and they're stuck. They can't sell without taking a loss, and they can't refinance easily because the property doesn't appraise high enough. It's a trap. And it's one of those unintended consequences of a well-meaning government scheme that didn't think through the market dynamics it would create. The new build premium is still an issue today, by the way. Developers are offering incentives like 5% deposits or free legal fees to shift stock, but those costs are often baked into an inflated asking price. So you think you're getting a deal, but you're actually overpaying and starting with negative equity from day one. If you're considering a new build, you need to do serious research on what comparable resale properties in the area are going for. The shiny new kitchen and the lack of chain might be appealing, but not if you're paying £30,000 over market value for the privilege. Buyer confidence is at multi-year lows right now. Despite expectations that interest rates would come down, they haven't fallen as quickly as people hoped. The Bank of England has kept rates elevated to control inflation, and mortgage lenders aren't passing on cuts as aggressively as borrowers would like. So people who were waiting for rates to drop to 3.5% or 4% before buying are still waiting, and they might be waiting a lot longer than they think. This lack of confidence is keeping transaction volumes suppressed, which means the market is stuck in this weird limbo. Sellers can't get the prices they want, buyers don't want to commit, and everyone's just hoping something changes. So what's actually going to happen over the next few years? Let's look at what the experts are saying, because some of these forecasts are pretty surprising. Most analysts are predicting modest growth in 2025, maybe 1% nationally, with some regions doing better and others worse. But then things get interesting. Savills, one of the big property consultancies, is forecasting total growth of 24% over the next 5 years from 2025 to 2029. That's nearly a quarter more in value. Now, before you get too excited, remember that's not evenly distributed. London and the South might see 15% to 18%, while the North could see 30% or more. But even at the lower end, that's significant. The theory behind this forecast is pretty straightforward. Wage growth is expected to average around 22% by 2029. As people earn more, they can afford higher mortgage payments even if rates stay elevated. The Bank of England is expected to gradually reduce the base rate down to around 4.25%, which would bring mortgage rates down to maybe 5% for decent deals. That's still higher than the 2% we saw during the pandemic, but it's manageable for most people. As rates stabilise and wages grow, confidence will return and transaction volumes will pick up. Once transactions increase, prices will follow because demand will outstrip supply again, especially in regions where building hasn't kept pace with population growth. The opportunity window for buyers and investors is right now, in this period of uncertainty. When everyone else is paralysed and not acting, that's when you can negotiate the best deals. If you're a first-time buyer and you've been saving, this is arguably one of the best times in the last 5 years to actually make a move. Yes, mortgage rates are higher than they were, but prices are lower than they would have been, and you have negotiating power. If you're an investor, the landlords exiting the market are creating opportunities to pick up properties below market value, especially if you're buying with cash or a large deposit. The key is doing your due diligence, understanding the numbers, and not getting emotional about it. Government schemes and regulations are continuing to reshape the market in ways most people aren't paying attention to. Selective licensing schemes are expanding in many councils, which means landlords have to pay for licenses and meet higher standards to rent out properties. That sounds good for tenants, and it can be, but it also adds cost and hassle for landlords, which pushes more of them towards selling. The scrapping of furnished holiday let tax benefits from April 2025 is going to hit coastal towns and tourist areas particularly hard. Properties that were rented out as holiday lets are either being sold or converted to long-term rentals, which is changing the dynamics in those markets. The Renters Reform Bill is probably the biggest regulatory change, though. Removing Section 21 fundamentally alters the landlord-tenant relationship. Landlords can't just decide they want their property back anymore. They need a legitimate reason to evict. That's great for tenant security, but it makes landlords nervous, especially smaller ones who only have 1 or 2 properties. If something goes wrong, if a tenant stops paying or damages the property, the process to resolve it is now longer and more expensive. For professional landlords with multiple properties and proper systems in place, this is manageable. But for the accidental landlord, or the person who's just kept their old house as a rental, it's often the final straw that makes them sell. What this all means depends entirely on where you sit in the market. If you're a homeowner with no plans to move, and your mortgage is affordable, you can basically ignore most of this and just wait it out. Your property value might dip slightly or stay flat for a while, but over the long term, you'll be fine. If you're a homeowner coming off a fixed rate in the next year or 2, you need to be proactive. Talk to a mortgage broker now, not 3 months before your deal expires. Understand what rates you're likely to get and whether you can afford them. If the numbers don't work, it might be better to sell now while you still have equity rather than waiting until you're forced to sell in a worse position. If you're renting and thinking about buying, the message is simple. Do the math. Don't buy just because you feel like you should or because your parents keep telling you rent is dead money. Buy because the numbers make sense for your situation. If you're in London and you'd have to borrow £400,000 to buy a tiny flat, but you're only planning to stay in the city for 3 more years, renting might genuinely be the smarter move. But if you're in Manchester or Birmingham, And you can buy a decent place for £180,000 with a mortgage that costs the same or less than your rent, then buying makes absolute sense. If you're a landlord, you need to decide whether you're in this professionally or whether you're just hanging on out of habit. The market has changed. The days of easy money from property are over for now. If you can't make the numbers work with mortgage rates at 5% and increased regulation, then selling might be the right call. But if you're in it for the long term, with good properties in strong locations and solid cash flow, then riding out this period could position you really well for the next cycle. The landlords exiting now are often the ones who are barely breaking even anyway. The ones staying are the ones who know what they're doing. For investors with cash or access to finance, this is genuinely an interesting time. The market is repricing, and there are motivated sellers everywhere. You're not going to find the bargains that existed in 2008 or 2009, but you can definitely negotiate deals that wouldn't have been possible 2 years ago. The key is focusing on areas with strong fundamentals, good transport links, employment opportunities, universities, hospitals, all the things that create consistent rental demand. And you need to run conservative numbers. Assume rates stay at 5% for the next few years. Assume some void periods and maintenance costs. If the deal still works with those assumptions, it's probably a decent investment. The biggest thing to watch over the next few months is transaction volumes. If sales start picking up, that's a leading indicator that confidence is returning and prices will stabilize or start rising. If transactions stay suppressed, we could see further price weakness, especially in the south. Also, keep an eye on the Bank of England's base rate decisions. Any cuts will filter through to mortgage rates within weeks, and that could unlock a lot of pent-up demand from people who've been sitting on the sidelines. Employment data matters too. If unemployment starts rising, that puts pressure on everything because people lose their jobs and can't afford mortgages. What we're witnessing right now is a fundamental reshaping of property ownership in the UK. The generation that bought cheap in the 1980s and 1990s is sitting on massive equity and owns most properties outright. The generation trying to buy now is facing the highest prices relative to wages in modern history. And mortgage rates that, while lower than the 1980s in absolute terms, are high compared to what we've seen in the last 15 years. This creates a wealth transfer situation where property ownership becomes increasingly concentrated among those who already own, while younger people struggle to get on the ladder at all. But within every crisis is opportunity, and this market is no different. The regional divide means there are affordable areas with growth potential if you're willing to look beyond London and the southeast. The landlord exodus means there are properties available that weren't for sale 2 years ago. The mortgage rate shock means some sellers are motivated in a way they wouldn't normally be. The key is understanding the market, knowing your numbers, and being ready to act when the right opportunity comes along. Over the next few years, we're going to see which predictions play out. Will wages grow fast enough to support the price growth forecasts? Will interest rates come down as expected? Or will inflation force them to stay higher for longer? Will the government introduce new schemes to support buyers? Or will they focus on building more homes to increase supply? These are the questions that will determine whether property becomes more or less affordable and who gets to participate in ownership. One thing's for certain. The UK property market of 2029 is going to look very different from the market we had in 2019. The cheap money era is over. The days of buying any property anywhere and watching it double in value in 10 years are gone. The new market rewards people who do their homework, who understand the numbers, and who can spot value where others see risk. It punishes people who buy emotionally, who overpay because they're desperate, or who assume prices only ever go up. The generational wealth transfer happening through property is one of the biggest economic stories that nobody's really talking about in mainstream media. Parents helping kids with deposits, inheritance being used to buy property outright, older generations owning multiple properties while younger people struggle to own one. This isn't sustainable long term. And eventually, something has to give. Whether that's government intervention, a major price correction, or just a very long period of stagnant prices while wages catch up, we'll see. But the market we have today is setting up the conditions for major change. So whether you're watching all this as a homeowner, hoping your value holds up, a renter trying to figure out if you'll ever afford to buy, or an investor looking for opportunities, the message is the same. Pay attention. The market is telling you something right now. Prices falling in the south, rising in the north. Landlords exiting, transactions down, mortgage rates elevated. These aren't random data points, they're signals. And if you can read those signals correctly, you can make decisions that put you in a much better position for whatever comes next. The property market isn't crashing, but it's not booming either. It's reshaping, and how you respond to that reshape will determine whether you thrive or just survive in the coming years.